Today, we're cutting through the noise on one of the biggest trade tensions we've seen in a decade.
It's a huge one.
The clash between China and the European Union over electric vehicles. For 2 years, this thing has been pitting this incredibly fast, low-cost EV expansion against the defense of Europe's own domestic industry.
And then, almost out of nowhere, that tension has reached what the China-EU Chamber of Commerce is actually calling a soft landing.
A soft landing.
Yep. We've been digging into the industry analysis, particularly from the Electric Vehicle Observer, and our mission today is to really give you the essential playbook on what just happened.
Right. So our mission is to understand the high-stakes history that got us to the brink, break down the core of this resolution, this price commitment mechanism, and most importantly, figure out which Chinese EV players are now best positioned to thrive in this new reality of value competition.
And the breakthrough news dropped on January 12th. The EU has agreed to, temporarily suspend those heavy punitive tariffs they'd been threatening.
But not for free. There was a big catch.
A very big catch. It's only in exchange for that's the key. That jump represented a 128% year-over-year increase. That kind of speed, it just signals that a foreign industry is leveraging advantages of scale and cost that are fundamentally disruptive to the local producers.
And that rapid low-price expansion immediately triggered serious political anxiety, especially in places like France and Germany, who have these massive domestic auto sectors to protect.
Right.
They started arguing that this price advantage was unfair, that it was all coming from state subsidies back in China.
And that anxiety, it culminated in the formal political response. On October 4th, 2023, the European Commission officially announced its anti-subsidy investigation.
The clock was ticking.
The clock was definitely ticking for the Chinese firms.
And the tariffs that followed, they were designed to be a complete wall, weren't they? They escalated so quickly from just threats to these truly massive cost burdens.
Oh, they were absolutely designed as a deterrent. The process started with some preliminary tariffs back in June 2024, which were already high.
How high are we talking?
Well, for instance, a cooperating firm like BYD was hit with 17.4%. But then firms that were seen as less cooperative, like SAIQ, they were facing a huge 37.6% rate.
But the final ruling, the one in October 2024, that was the real cost wall.
It was dramatic. The final countervailing duties for the cooperating firms averaged out at about 20.7%.
Okay.
But when you stack that on top of the existing 10% base tariff, you're talking about average cost pressure around 30.7%.
And for the non-cooperating firms?
It was staggering. The combined rate approached 45%.
Let's just ground that for you listening. What does a nearly 45% tariff actually mean on an economy car?
It means market death for your entry-level models. It's that simple.
Right.
Yeah, think about it. If a popular economy MG model, for example, has a retail price of, say, €20,000, that 45% tariff means you're immediately adding another €9,000 just to get the car across the border.
And that's before shipping, before dealer margins.
Exactly, before anything else. That tariff alone makes the vehicle completely uncompetitive against a local $20,000 alternative. This existential threat is precisely what forced the Chinese automakers to adapt so quickly.
And this is where it gets really tactically fascinating. The Chinese automakers didn't just wait for a resolution. They didn't retreat.
Not at all.
Instead, they executed this incredible product strategy pivot at, unbelievable speed to navigate around this tariff wall.
They showed incredible agility. The data point that just captures this perfectly is the contrast between the two key vehicle categories in 2025.
Okay, so let's look at that.
So for the period from January to November, you have pure electric vehicles, the BEVs, facing the most severe tariff threat. Their export growth rate to the EU slowed down a lot. It only rose by about 15%.
15%, which is modest. It sounds like the tariffs were actually working, to slow down pure EV entry.
On the surface, yes. But here's their countermove. Plug-in hybrid electric vehicles, PHEVs. That category just absolutely exploded. It grew by an unbelievable 363% over the same 11 months.
363%. That's an astronomical number. Just to put that in perspective, are we talking about a jump from a few hundred units to a few thousand, or was the volume behind that number actually substantial?
It was substantial. That's the key. While the volumes vary, this shift means tens of thousands of units moved into that PHEV and HEV category. They successfully offset the policy pressure.
So why did that work? Was it a loophole?
It was effectively a regulatory loophole. The anti-subsidy investigation and those punitive tariffs were focused specifically on pure electric vehicles. The rules didn't cover hybrids, even though they're a huge part of the electrified market.
So they found a way to continue their growth trajectory just under a different product banner. It bought them time for the diplomatic solution that we're talking about now.
Exactly. And the outcome of that pivot is clear. Despite this near 45% tariff threat on their main BEV models, Chinese brands still managed to grow their total market share, including the hybrids, to over 13% of the European market by November 2025.
And the pure EV share?
It remained robust at 12.8%. So the policy threat, it forced product diversification, but it completely failed to stop their overall market momentum.
Which brings us to the resolution, the thing that halted this looming trade war, the soft landing, as the Chamber of Commerce called it.
Right.
The core of that agreement is this guidance document for submitting price commitment applications.
Yes, and the mechanism itself is, simple in concept, but really complex in its implications. In essence, the EU is trading the suspension of tariffs for a guarantee that Chinese exporters won't dump underpriced vehicles into their market.
So walk us through the mechanics. How does this minimum price commitment actually work? How is it verified?
It works in 3 core stages. First, the individual Chinese exporter has to propose and commit to a non-discriminatory minimum selling price. That's the price commitment.
Okay.
Second, the EU then rigorously assesses that commitment. And crucially, this usually means they'll scrutinize the price relative to the cost of production and sale in the EU market to make sure it prevents, injurious pricing.
And then the third step.
Once that minimum price is agreed upon and accepted, the punitive anti-subsidy tariffs are immediately suspended for that specific manufacturer.
It sounds like a pretty classic trade compromise.
Yeah.
But you said earlier this forces a long-term industry transformation. What are the big strategic values here for the EU?
Well, the first is what you mentioned, stabilization. It's about keeping the channel open while imposing conditions. For a high-volume producer like SAIC, who faced the highest tariff, this mechanism avoided a catastrophic market exit. It keeps them in the game.
But what's the major long-term consequence for the Chinese manufacturers themselves?
That's the second value, the industrial upgrade mandate. This commitment absolutely terminates the thin profit, high volume model in Europe. It's over. It forces companies to stop relying on selling entry-level economy models at these aggressively low prices. If you have to commit to selling above a certain price floor, you are immediately incentivized to shift your resources to promoting mid-size, large, and premium intelligent models just to justify that new higher price.
That's a fascinating constraint. So if they have to charge more anyway, they might as well spend more on features like advanced driver assistance systems or LiDAR to genuinely command that premium.
Exactly.
But wait, isn't forcing them upmarket just handing the entry-level segment back to European manufacturers? Couldn't that make vehicles like the VW ID.2 suddenly look way more competitive?
And that's the critical tension this resolution creates. It's why this term value competition is so important now. Chinese companies can't just compete on cost anymore. They have to compete on technology and brand cachet.
If they fail.
If they fail to demonstrate that superior value at the new mandated price, then yes, they absolutely risk ceding that high-volume entry segment back to the local players.
And the third strategic value.
Localization acceleration. This price commitment doesn't just manage prices, it significantly encourages building factories in Europe.
Why is that?
Because producing locally drastically reduces your logistics costs, and it completely eliminates future risk from any trade duties on imported vehicles. And we're already seeing the results.
Right. BYD in Hungary.
BYD's new factory in Hungary, Chery's plans for Spain, Leap Motor leveraging the Stellantis network. And this isn't just about assembly. They're pulling their entire Chinese component supply chain with them, creating this truly synergistic China-EU manufacturing base.
Okay, now let's turn this into actionable insight for you. With price competition essentially terminated, who are the clear winners in this new era of value competition?
I think you can really divide them into a few categories.
Let's start with the ones who are already playing in that space, the companies already operating above the expected minimum price floor.
Right, the ones who are positioned beautifully. And the first name that comes to mind is BYD.
Of course.
They already focus on mid to high-end models, typically priced above $35,000. They saw massive EU market growth, 240% in the first 11 months of 2025. And that early commitment to the Hungary factory means they are already way ahead on mitigating future trade risk.
So for BYD, the tariff suspension is just pure upside.
It's pure upside. It basically confirms their strategic pricing was correct all along.
And what about NIO, the premium pure play?
NIO is also a very strong winner here. Their premium pricing, their focus on services like the battery swap network, it all means the price commitment has a minimal operational effect on them.
In fact, you could argue it helps them.
It could. By removing the threat of tariffs, their existing cost advantage against rivals like BMW and Tesla is now amplified. They can just focus entirely on brand and service.
Okay, what about the players who compete more on technology? I'm thinking of XPeng.
XPeng fits that category perfectly. Their whole success is built on intelligent features in models like the P7, the G9, the G6. That translates directly into perceived value.
And their growth has been strong.
Very strong. They have a channel presence in 10 European countries and showed robust growth of nearly 288% last year. Their brand loyalty, built on technology, gives them the perfect buffer to command the higher prices this new mechanism demands.
All right, finally, let's analyze the companies that face the highest risks, the ones who now have to re-strategize their product lines pretty dramatically.
And SAI Group is the #1 example here. They were facing that adjusted 36.3% tariff threat. The price commitment basically saved them from having to pull their entry-level MG models out of Europe entirely.
So what's their play now?
Now they have to immediately accelerate their move-up market. They have to force their entry-level models to offer way more technology, better trim packages, just to justify a price above that new floor.
But they've shown they can adapt.
They have. Their quick shift to hybrid electric vehicles in 2025 proved they can pivot, but the real heavy lifting for them starts now.
And Geely. They have such a massive, diverse portfolio of brands.
And that's what insulates Geely. Their high-end Zeekr brand is already thriving. European sales up 120%. Their strategy is just to leverage multiple brands to fill different price niches. Plus, their partnership with Renault shows a much broader strategy for regional competitiveness.
Okay, what about Leapmotor? They had huge success with their microcar, the TO3, a volume story that now needs a pivot.
Leapmotor is a fascinating case. The TO3 was a top 5 seller in November 2025, which proves there is huge demand for their economy models.
But that's the segment that's now under pressure.
Exactly. The price commitment forces them to move away from that economy niche. Their plan is to introduce a new global model every year from their B platform and, critically, leverage the massive distribution muscle of the Stellantis group. That is their key to survival in this new high-value environment.
And the final one, Great Wall Motors, GWM, who seemed to kind of lose confidence in Europe last year.
Yeah. GWM is the ultimate turnaround story, or at least the potential for one. They scaled back in a big way, closed their Munich HQ, shifted to a remote agency model last May. Their foundation was just too weak.
So this is a second chance for them.
It's a window of opportunity. This agreement gives GWM a chance to re-enter the pure EV and PHEV markets, but they have to accelerate their localization and brand building faster than anyone else just to catch up.
So if we summarize this new phase for Chinese EVs in Europe, the deal signals 3 non-negotiable requirements for success.
That's right.
Compliance with the new price structure, a firm high-end focus across your entire portfolio, and a relentless push for localization of manufacturing. The low-price competition model is dead.
Correct. The trade channel is now compliance-based, and that compliance requires premium pricing. Now, this mechanism is expected to stabilize growth, not kill it. Projections suggest Chinese EV exports to the EU will still maintain a very healthy 20% annual growth rate between 2026 and 2028.
But the mindset has to change.
The mindset has to completely change. The future requires these firms to move far past simple manufacturing prowess. They have to leverage proprietary innovation and develop genuine, desirable brands.
Which brings us to the long view and, I suppose, the ultimate test of this soft landing.
The immediate threat of punitive tariffs is gone. But the competitive landscape has fundamentally changed forever. This price commitment forces Chinese companies to rely less on their massive manufacturing scale and cost cutting, and more on intangible assets, proprietary innovation, genuine brand cachet to justify that new, higher minimum price.
Right.
And this raises a really important question for you to consider. While this mechanism successfully solves the immediate trade dispute, is a forced shift to only high-end models truly sustainable across a broad product portfolio? Or will European consumers simply pivot their demand to lower-priced European alternatives that suddenly look much more competitive at the entry level? That is the real test of whether value or protectionism wins out in the long run.